Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. It is Tuesday, November 14th. It's 2 p.m. on the East Coast. Saying, what happened to you people? We're in Naples, Florida. I think they call this Tiburon. We're CME Cup. We've been here. This is our third year in a row. On my left, you see the great Danny Moses.
Hey there, guy.
On the right, obviously, Dan Nathan. We're all here for a singular cause for St. Jude, CME champions, that we can talk about it. But I don't want to bury the lead, as they say. So let's take a look at what we're going to talk about today. The everything rally. I mean, because of course it is, right? Yeah. And no more Fed hikes. Why would they have to do that? And strategists are still split right down the middle. Although more and more, Danny, are coming to the side of, well, things are going to go up in perpetuity. I am not one of those people. Dan, how are you today?
I'm doing great. It's great to have Danny on the market call
today. Little spontaneity here. I just joined. I don't think people think just because the market's up, I'm going to shy away.
I know.
Coming right.
No, you're coming. You're right here.
Right here.
So we just had a great conversation with Terry Duffy. He's the CEO of CME Group. They've been great partners of ours. To Guy's point, we are down here in support of this event that they are supporting St. Jude's, and so good on them. And they've been our partner from the get-go since we started the On the Tape podcast. That's why we thought this would be a great day to have Danny here. But guys, we got to just talk about this here. Okay. So the expectations for the CPI were 3.3%. We know that's down from that 9.1%, the summer of 2022. Okay. So I guess Fed Chair Powell is right. Guy, inflation was transitory.
I was in such a good mood.
I know you were in such a good mood.
Okay. And Danny was in a good mood. We had a salad. I feel good about Florida.
Okay. All right. But the fact that the knee-jerk reaction is for yields, okay, the 10-year yield to go down 20 basis points. The stock market in the NASDAQ is up 2+%. The S&P is up nearly 2%. Seems a little odd to me. We have a VIX at 14. Did you guys see this coming? I didn't see this coming.
I'll start this ball rolling and say absolutely not. Because if I had seen it coming, obviously I'd be singing a lot. I would have been singing a much different tune over the last couple of weeks. So yes, and we can throw up the headline. Inflation, I guess, by whatever metric has slowed clearly. But it doesn't mean it's still a problem. And my concern is on a day like today, and by the way, I don't particularly like him, but you got to give huge kudos to Bill Ackman, who in early August put out that he was short the bond market. I think at the time, 10-year yields were 4.15%, maybe 4.2. Yeah. They actually backed off a bit over the next couple of days. I think they got down to 3.9, but then obviously yields traded up to 5%. He top-ticked it in terms of his exit. And good for him. And he cited a couple different things. And quite frankly, they're coming to fruition. Personally, I didn't think we'd get here in terms of yields. I know you did, Dan. I know Carter did as well. I'm surprised, Danny. I still think there's a leg higher in yields. And I think it's going to come not on inflation data.
You're the only one, right?
And not on a slowing economy, but on a Treasury that's going to continue to have to raise debt. And they're going to have to pay a higher interest rate to get there.
Danny, all right, so let's just look at the 10-year Treasury, okay? We are 4 at 5. Like, that's the market. Do you agree with that? So when he talked about when Ackman made the trade, to 5, and then he took it off at 5, I mean, so we're right in the middle of that point here. So should equities be banging around from 4,000 in the S&P to 4,500? Think about that range.
This is the trap I talked about last week on the tape. Yeah. I said, you're going to have a situation where yields are going to pull in. It's going to be a buy signal to the markets because all the quants are lined up. Buy home builders, buy REITs, buy all these things. I would think that if you think the Fed is done, which I've felt that way a long time. Yep. Fed fund futures have been basically trading that. So that didn't change today. The 10-year yields, you could actually argue from a growth perspective. I don't think inflation is embedded in to the 10-year yields as much as I think it's a Treasury oxygen supply and demand. So you're right. On the margin, 4 by 5 is probably the right thing. But to me, this is an opportunity, and I'll say it again, to sell the names that you know, because there's nothing in the economy per se that's changed today by what that print was. As a matter of fact, one of the culprits of why you had a lower CPI is used car prices, right? Why are used car prices down? Obviously, because the ability
because Elon keeps cutting prices on Teslas.
Let's not bring up Tesla. But the ability to finance a car, the ability to buy a car, right? Those things. So prices are going to start to come down there. Somehow rent came down in that number, I believe, also. So a lot of moving parts. And again, it's still 3.2%, I think, on the main number, right? I think that's what they mean. So anyway, this is where you start to clean up your portfolio. And I'll say it again. Flip side of this is when you get a move down like we had a few weeks ago, opportunity to buy things. So this is, to me, an opportunity to trim. It's just what I think. And some stuff's not participating.
You're going to trade the S&P futures.
Oh, we're going to trade the S&P futures.
Yeah.
So we're right back where we were. We were at CME in Chicago. Now we're at CME in Naples.
5.
So
there for
Dan and I flew down here earlier today, but you reside down here. So you didn't have to get on an airplane, which allowed you the ability to have a conversation with our friend, Peter Bookvar. And I think you know, that was probably a conversation that you wanted. I know when I find myself on the ledge, I need like Batman, like Adam West or Burt Ward or somebody to sort of talk me off.
Well,
be my Adam West.
I was driving on Alligator Alley, contemplating getting out of the car and just swimming.
Right.
Going for a swim. Right. With the Gators. No,
by the way, the Gators down here.
Yeah, they're ferocious.
Did you see them? Did you when you're driving? You can see them on the side of the road.
No, my guy, when he's on the plane, I look straight ahead.
You called me and I answered from the plane. You were asleep.
So it's interesting.
I
was probably snoring. But tell people don't believe this, that I sit in my seat. The only reason I got up today is because
it's freaky. If you happen to be on a plane and you see Guy, putting his thing up there, and
I don't put anything.
The 1975 hanging back. I saw it today.
But what I'm saying is, if you see him getting on a plane, okay, and then just do this thing for me, okay, an hour later into the flight, just walk by him and see what he is doing.
I haven't moved.
No, he's sitting there
staring straight.
It would freak me out.
It is freaky.
So
looked over at him and I was freaked out.
The duration of the flight doesn't matter. I could be on a 30-minute flight to DC, which I don't do anymore, or I could get on a 16-hour flight to South Africa, which I have done, and I will do the same thing. And the only reason I get up today, I got up because you had to go to the bathroom and get some tissues. Yeah. Anyway, that's what we're here for.
So anyway, I call people like Peter because I just want sanity.
Obliquely advised. And the book report, who's also been on the Tape podcast, and he's been on the market call.
And he presents facts. That's what he writes his letter, presents facts, takes a position. He's long some stocks, he's short some stocks, he's long commodities and metals. I just wanted his read because I was in the car. I'm like, Peter, he goes, listen, we're about at the level where we are right now. It's a little bit overbought,
Well, the futures are 45.09, 45.10 right now.
So the RSI, et cetera, it's extended.
What's the RSI right now?
I don't have it in front of me. It's in the 70s. I mean, it's in the 70s. So it's very high, right? And so it's a knee-jerk reaction. And he's a little bit miffed, but we all understand it. People are offsides positioning. I also think that this time of year, right? Think about this. We came into the year, people were positioned to, defensively, right? Then first week of January, by second week, they chased. We're now on the opposite end, literally almost the exact time period. If you think about like January 15th, just substitute November. If you think about the end of February, just substitute, the end of this year, right? It's the flip side. So now you have this chase. Now, if you're a fund manager, you can't, here we go again. You can't miss it. You got to chase. I think that's what this is. So, a lot of things are moving. Again, I use it as a time to basically. All
right. So let's look at this real quickly. Amanda just made this chart, and shout out to our squad here. We got Jacob here. We got Amanda here. They're doing stuff on the fly. Obviously, Timmy and Steven back in New York helping us out too. Let's look at this chart. This is the S&P 500 versus the 10-year U.S. Treasury yield. You can see where the S&P was basically 41.90-ish. It got back to those lows. Did it overshoot a little bit, those kind of that May breakout level when the 10-year was at 5%. I mean, just look at that. So I guess my point is, Guy, if you are correct, if there are reasons other than the CPI for yields to go higher, so you're talking about auctions, right? Okay. If we are to head back towards 5%, where's the S&P going?
Well,
like to me, because
it goes right back down. Right. But again, I have to be clear. Did not think. By the way, we traded down to 4.5% last week, and I thought, okay, there you go. We traded down to the lower end of this up channel that rates have been in, and it makes sense. And now we're going to go ratcheting right back through 5%. We have broken down through that, and Carter has brought that chart to us a number of different times. Is it going to be a false breakdown in terms of yields? We're going to find out, I think. But the next Treasury auction, and Danny talks about this, he talked about it on our podcast last week. Everybody's become a specialist or I guess the word is an expert.
But is there anything wrong with that? But like literally, like we just had this great conversation with Terry. We're talking about people like getting educated and learning about the things. It's one of the things
I think it's great.
I actually think it's important. I didn't know much about like Treasury auctions.
But I think but what I think is, and answer your guys' question, people let the market moves dictate how they should think.
Yeah.
It's looking backwards instead of looking forward. Like, I don't think, if we get back to 5%, in the 10-year, it is because of a failed auction. It is because something else is right. It's not because of growth,
Right.
in my opinion.
Well, the
So in that
markets are
case,
not
what we
pricing
make-
it. Like,
right.
Yeah.
So in that case, so we're overshooting. It's all about positioning. We talked about it before. Obviously, people are still short bonds out there, right, that are now covering. If I'm Janet Yellen, I am literally calling an emergency auction meeting and throwing out as much as you can.
Look,
Okay?
that's a good. Stop for a second.
Yeah.
That's a great point you bring up. The yields are lower now. Now's the time to do. But how would that be received? The auction's going to be just as poor.
Well, we might have a government shutdown here in a couple days, also.
which is again nothing. And
Not
remember, we talked about this. The
whatever.
Moody's putting United States on credit watch. I mean, that should make yields good. There are a lot of things out there to be concerned about in the Treasury
Let me be
market.
positive for a second. Let me be
Please.
positive on this. So here we have this APAC. We have a conference going on, right, in San Francisco, I think, with Cheese here. Like we all getting together.
What'd you call him? Chi?
What?
Chi?
No.
Xi.
G.
President Xi.
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 Oh, I'm sorry.
Yeah.
I've never met him personally.
I
but-
know,
Right.
but it's
Anyway.
a simple. It's two letters.
I never met Lincoln either, but I can pronounce
Very
it.
one
good.
syllable.
All right.
I mean,
Whatever.
a one-syllable name.
Okay. Very
Sorry.
good. Anyway, great. Take fentanyl off the market. I think that would be honestly, that's the greatest thing ever.
Yeah.
But maybe that's a sign of a breakthrough. All right, we're going to do some other things. Listen, China has no growth. They need us, right? And if you want to believe it or not, we need them economically. We need their market to pick up. We need to still produce things there. So shove the Taiwan risk to the side for a moment, right? And focus on positives, what could come out of that. You're seeing a lot of the companies that are levered towards China outperform the market right here. And I think that is a positive. I mean, those thawing at all on those relations would be a positive. I'm just coming up with other reasons that the market could be rallying.
I think that, listen, a thawing of a really poor relationship with China at a time where, from an economic standpoint, a geopolitical standpoint, the tit for tat that we have going on with just the kind of export controls and everything like that, I think would be a really good thing. There's been a lot of really good stuff written over the last couple of days, whether it comes to fruition or not, about who needs this meeting more. It seems like it's leaning a little bit towards President Xi. I think there was an article in the Wall Street Journal this morning. There was one in the Washington Post. They're talking about basically deflation and the housing-induced credit bubble that they have, the local debt bubble that they have. You know what I mean? Like it's happening right there. And I guess the bigger risk is that we have incentives to kind of maybe not be so tough right now. Biden clearly does from a political standpoint, but they will export that deflation. Let's be very clear, right? Like that's not like going to avoid our shores or Europe or anything like that. So I think it makes sense that we could all just chill out a little bit. Don't you think?
Chill out. I like
All
that.
right, let's go to the S&P futures really quickly. Let's do a 1 year. So on September 5th, Danny and I were at CME in Chicago. We were there for Pearl Jam. Amazing show. You put a trade on in the futures. I think they were right around the S&P futures, right around 4,500, right about where they are right now.
Literally where they were.
You caught that move. You came on market call and you took it off. You kept lowering your stop. Okay, so when you put that trade on, you put a stop above where if it
4,600
continue to go higher, you get taken out. You're defining your risk. Didn't happen. You kept on lowering your stop, and then finally you took the profit. What do you want to do right now? We got 45.10 on the S&P futures or so. 45.05, Danny. We know that.
I know I'm going to shock people. I would sell.
Oh, you're not buying them.
Yeah.
Okay, so let's be very good. So you're selling them at 45.05, and you want to put that same stop in at 4,600.
Yep, same thing.
So basically, if the market's going to rip roar in the year end, you're going to get taken out at 4,600. And then what would your initial target be again? Are you looking something?
Listen, the time of year, right? This is you're approaching. I think once you're post Thanksgiving, there's not many trading days left that are really meaningful. So you obviously got to be smart. So, but I think we'll get a retrenchment here. We'll get some type of pullback. I would think we get some type of pullback, but I would say half at 4,400 and the other half at 4,300, the same way that I was doing it last time. So
part of the tease in our rundown, which Amanda put together, well done, Amanda, was talking about mixed and the strategist. So we created a slide to illustrate just that. And now I'm going to agitate Danny, and I'm agitating myself. But last evening on, what's Brian Sullivan's show called?
The Last Call.
Why is that?
Because it's the last show. On
what are you about
CNBC
to do
at
with
7
me on
p.m.
live thing?
Last call.
Okay.
Well, last call. Yeah, you're right. It's the last live show.
Yeah.
Then they do like treasure hunt.
But it's also a planned word, right? So if you're at a bar and it's about to close, they're going to say, hey, it's the last call. So you get your last drink order in. That's it.
That's never happened to me. So it should come as no surprise. I haven't not been in a bar.
You know what? 2 years ago, we closed down the bar in this hotel.
Can I say it's not saying a lot?
Yes, we did.
This town closes at 8 o'clock at night.
No,
We'll see
it was like
about that.
11 o'clock, and we were with Terry. Do you remember that?
I
We're
do
doxing
remember.
him right now.
Anyway.
And we had a last call. We had a last scotch.
I'm sorry to do this, but he did say this. A couple of prints ago, Tom Lee went on one of those shows and talked about, a face-ripping rally post CPI print. That's exactly what happened. And he did the same thing last night.
Yeah.
And here we are. And
how did he know?
You got to give credit where credit's due. The flip side of that coin is Marko Kolanovic from JP Morgan, who's still in the camp. You got to fade rallies. And obviously, where I stand. I'm still with Marko, but that's the market that we find ourselves in. These rallies are fierce. And I talked about this all of last year, Dan. The only time I saw panic last year was on those vicious up days back in June of 2022 when the market rallied, I think, 18%. Then again, it happened in October when you had that rally off of VIX, both times that it traded about the 34, 35. Today feels like, to me at least, and I'm not saying it's human beings, but it has all the benchmarks, Danny, of panic buying because holy shit, I'm going to miss it.
You can't miss it. So, yeah, we've had Tom on the podcast. He came on September 1st, I believe, right before we went to Chicago. And we had a bet for the month of September. And we're here at CME, which donates all the proceeds to St. Jude, right? And Tom agreed to give $1,000 if the market was down in September to my charity of choice. It was St. Jude's. I think he's done it. I would assume that he's donated it at this point.
He's a stand-up
of
dude.
course. So point is this. Think about the fluctuations that we've had in the market since then, right? Down 300 or 400, down 300 on the S&P, back up. You can get chopped up in this market if you trade it. And I'll say it again. I know we're showing indices and we're picking in S&P futures, but within that, in down moves and up moves, there's opportunities kind of on both sides to kind of make money in it. And I think from a single name perspective, don't get caught up in the ETFs. Yes, of course you're going to buy the XHB today. Of course you're going to buy the IYR today because when rates come in like that, the signal is to buy the interest rate sensitive stuff. But to me, nothing's changed to me because I thought the Fed was done. I think a Fed cut's coming sooner than I thought. Yet I'm not long. But, so maybe I'm overthinking it. Keep it simple. The chase is on. This is the performance run now. You cannot miss. We have
so you might want to use a tighter stop in your S&P futures trade to the short side. I'm just saying if the chase is on. Well, here's a couple things that I want to say. You said you try to be positive. So I started out the week. There was a couple things that kind of, like I really want to be cognizant of. The outperformance last Friday of the semiconductor index. Okay. The SMH was up 4% last Friday. Okay. NVIDIA was has gone up. You ready for this? It's gone up 25% in a straight line in a month. That is $250 billion in market cap. Okay. AMD got off the mat. Intel was at 52-week highs. Taiwan Semiconductor, which 3 weeks ago told us that some of their end markets are starting to firm or whatever. So this is the most cyclical part of technology, okay, that had been getting knocked around other than NVIDIA over the last prior few months. Was trading really well. Okay, so that Microsoft Friday closed at a new all-time high. So there were some things there. If you think about leadership, the sorts of things that might drag things up. Now we could have pointed, well, the RSP, that's the equal weight S&P, did not trade well. Okay, Russell 2000. Okay, if Amanda can pull up the Russell 2000 futures here. This is up nearly 5% today. On the day. Okay. So there's some things happening, you know what I mean? That I think, again, going back to your short trade, like I put a trade on in the QQQ last week. It was the first thing I did a week ago, Monday. Okay. And I defined my risk. Options look cheap. They look cheap for a reason. Now, if you bought calls, you would be like laughing all the way to the bank because they were dollar cheap looking out to December and vol cheap. But right now I'm so far out of the money. That's not a good way to do it.
So what's your trade here, Dan? Then are you gonna nowhere? Are you saying
I'm literally sitting on my hands a little bit? You know what I mean?
Fair enough.
Because these things do overshoot to the upside the way they do to the downside, and I don't have a lot of conviction. I will tell you, if we get through this weekend and there is no government shutdown, okay, they kick the can to January, then the chase that you're talking about is on. Like think about it. They have the opportunity to well, what would be the thing? Is there something in the Middle East? Is there something in Ukraine? Is there some lurking earnings bomb that's going to come out? NVIDIA reports November 21st. I think it's Wednesday or something like that. I don't know. Is that going to be a thing? If anything, if that stock sells off, it's just going to be relative to expectations.
All fair. Listen, you're 100% right. If there's, and my sense is,
I'm just saying,
my sense is, we will avert another disaster in government vis-a-vis, whatever continuing resolution type thing. I don't even know what they can do at this point. But let's just talk about, the here and now. And Doug Cass points out correctly, at a certain point, the consumer is still strapped. And although inflation has, people, I think, and I'm not pretending I'm an economist, I'm not, but inflation isn't going lower. It's just going up less quickly, which is not nuanced. I mean, that's just what that number tells you. So there's also a cumulative effect of this over the last few years. I mean, people are paying anywhere from high teens to mid 20s more for things.
The other side,
the consumer is in a very difficult position.
The other side, Danny, to this inflation data is that the economy is slowing.
Correct.
So
That's
to
Mike
your
Wilson's
point,
theory.
So here's guys. Here's another thing that's flashing. Like it's just flashing. Let's pull up the dollar index, U.S. dollar index, the Dixie. This is a huge one-day move. I mean, so we're seeing some massive palpitations in major risk assets that are probably, I'm just saying this from my experience, it's kind of hard to fade days like this when you see Danny, help me out. When's the last time you've seen the U.S. dollar index move like this?
I mean, not that I
in
can
one
remember.
day.
It happened. I see it back there on your chart.
Look at the chart. I mean,
but again, people's hands are going to get forced here, right? And you bring up a good point. I mean, credit card debt all-time high, auto all-time high, all these delinquencies, normalization of the markets. This doesn't change anything today.
No,
right? It doesn't change.
But it's a continuing resolution.
But I will tell you this:
the can down the road.
I will tell you this: the reason Moody's stock is up so much today, because you talk about the Treasury trying to unload paper. If you're a company right now, you're like, okay, here's my window, right? Rates just came in 50 basis points on the 10-year, right? And that's a big difference when you're issuing hundreds of millions of dollars in terms of expense. Get it out. Let's see what the flows are going to look like. You're going to see issuance here towards the end of the year probably take off, right? Those are the things that can happen. And that can be a positive in terms of cost of capital of what you thought. So, but again, I only think the good companies can have access to that. I don't think that the bad companies can get funded still, because I think, again, it's very selective in the debt markets and in the equity markets.
We're on a CME day, so let's take a look at a couple of their commodities. Gold's having a big day here today, and makes sense. Dollar's lower. Gold's back on its horse. It seems, Danny, like we've defended the downside a couple times here. I will tell you flat out that if you had told me all the things that would have transpired over the last couple months, I thought gold would have been north of 2,500, if not a new handle in terms of 3,000. Obviously, we're not even close. But the here and now, again, I still think the gold trade is maybe not alive and well, but it's not dying the way a lot of people think it is.
Yeah, we talk about it. It had a nice run from 1850 basically to 2000. It pulled into 1925. Rough, don't quote me on those, but roughly I keep talking about it. Just buy it. Just buy that. I'm not in there for short-term trade. It's a long-term trade, and if things pan out over, how I think they will over time, I think gold will outperform. And when yields come in, obviously in conjunction with the dollar pulling in, but when yields pulling, gold becomes more attractive on a relative basis. You can make that argument. So I think it's in firm hands. I really do. And I think on the margin, I think you can have these fluctuations. It's going to take something else though, Guy. It'll take a true economic slowdown with a pull forward of the Fed cutting rates. God forbid it takes a geopolitical issue occurring to do it, but I'm a buyer and holder of gold.
Crude oil obviously went through moving averages on the downside, but here we are back going through it on the upside. And talk about CPI. I mean, it's always X food and energy, which obviously is just asinine beyond words. But crude is showing some, and it makes sense. Was at least showing some strength earlier. I still think there's a leg higher here in crude, Danny, that people and the equities, which is interesting to me,
trade horribly.
I think what we're seeing there, and
those are defensive by nature.
And I think what happened is money flew out of there into these high-flying technology growth names, which I guess makes sense to a point, but I don't think people are fully comprehending what's going on in the space.
I think the key with oil, and we had who do we have on last week? Halima Croft came on last week on the tape.
Moment.
What's that?
You just had
I was thinking about something else.
We're boring you? Are we boring
No, I was thinking about something else. We had her on, and I asked her the question: how do you price in geopolitical risk versus just kind of supply and demand into the price of oil? Right? What does that look like? How do you strip it out? She was pretty adamant that oil really had nowhere to go but up from there, because she believed that they were pricing zero geopolitical risk at that point. So I'm a buyer of oil, and I think again the energy stocks aren't going to do well on a day like today, obviously. So I think, but I don't know how they're doing. I know they're down.
They're not. I mean,
on a relative
it's
basis,
funny. Crude got to nearly 80. It's trading down 1.5% from those levels. The XLE is barely up. It's up, 70 bips or something like that. It's interesting. I would think that energy, because of the valuation, because of how hard they've been hit of late, because of if you're see that's the thing. Okay, so I was going to say, if you believe that equities are better because the economy is better, because corporate earnings are going to be better, because soft landing, yada yada. That's not why equities are rallying today. You know what I mean? And I don't mean to sound a little whiny here, you know what I mean? But they're not rallying because all of a sudden we got a bunch of data that suggests we are confirmed soft landing here and the Fed can do mission impossible.
Yields would be pulling in like this on the longer end if that was the case. That's my point.
Yeah.
What's trading really well today, and you don't see this instrument trade that well historically, is the HYG. And this is something
high yield.
Yeah, the high yield ETF. And this is something that does not trade like this. But when you look at it, having a move like it's having to the upside, it suggests a couple things. It probably suggests that people just got themselves way off sides. I'm being one of those people that thought it would continue to push through 72. It's trading today as if there's going to be no credit event whatsoever. But nothing, Danny, other than rates going lower on the credit side of things has really changed all that much. And more, you hear more and more people, loan loss provisions, credit risk has to go up by definition for a lot of these banks. Reserves for credit risk. I mean, it's out there. It did not improve today. The ETF suggesting that it did, but not to your
I think people use it as a hedge. So people use that instrument as a hedge. And I just mentioned before you, I think you'll see a flow of deals that come our way, right? So, but it is. Listen, let's be honest. If the Fed is truly done, which everyone believes that they are, but maybe if the pull forward is the Fed has the ability to cut sooner. Right, maybe the beginning of the year. I mean,
UBS Fed funds futures are pricing now?
It's May, but it could go to March. Yeah. But the point is that is meaningful from a funding cost perspective, because again, I believe this is just telling you what we already knew. The economy is so financialized, and we are so reliant upon this that you are going to get. Listen, you get a huge sell-off when rates move higher. And obviously you get a bounce when kind of rates move lower here. But listen, this is the instrument that matters the most, but I still believe. It's still a trap here.
So Bank of America is up 5.5% today. 5.5% today. Yeah. Okay, 0.1% less in the CPI. 20 basis points lower in the 10-year.
People are underweight financials.
No, I know, but it's just like that doesn't make sense. So back to Guy's point about panic buying, you know what I mean?
But Dan, it does. But Dan, people that want to put their bullish hat on it does. Here's why it makes sense. Okay. If you believe that they have achieved the soft landing is right in front of us, let's just say that's the case.
Yeah.
M&A picks up. The IPO calendar picks up, right? The health of retail, everything gets better. So again, knee-jerk reaction higher. People are underweight it. They're chasing.
But that's the one thing that to me is today's piece of data is the reason that you're gonna just say, okay, I have a new thesis now for 2024.
No, I'm not.
No, I know not you, but what I'm saying is, there's a couple things, and you were on Fast Money with us for the full hour last week, and that was a lot of fun. It was on Thursday, and I love the show. You've been doing it for 28 years. I've been doing it for 11 or something like that. And there's one thing that I hate about the show is that no matter what happens in the trading day, we are always, what do we have? Like a minute, minute 10, minute 15 left as we come back to our last break. And it's like the final trade.
Yeah.
And literally we have a woman, usually a page comes out to us at 52 minutes after the hour or whatever. And she says, all right, I need your final trade.
Right.
And just, the final trade is the most looked at, I think Amanda can confirm that, piece of video of the whole hour that we do that they put on after the fact. And I actually said, as in a really glib sort of fashion, if the CPI comes in hot tomorrow, I think you want to sell the banks, okay? You want to sell the XLL. Look at this.
That was your final trade yesterday?
Yeah, lazy as crap, okay? But I hate it because it's not a substantive sort of conversation or whatever, you know what I mean, or whatever. So I look like a jerk, and people forget. When you're on a trading desk and you're managing a portfolio, you do dumb things. You say dumb things all the time, right, Danny? Isn't that bad?
Let me just say this. I want to say something because it's important. But I think you bring up a point. People measure ideas, trades in hours and minutes and maybe a day. The thoughtfulness, at least with what I try to do, whether it's a GameStop or a Carvana or an AMC, I know those are names that not everybody trades on the institutional side, but they're important to retail. Is I short bad business models. Yeah. Right. That's again, everything else, I don't short good business models. You mean maybe on the margin as a hedge of something else, but CME is like an example of a great model of a business that I would only want to
But
be long.
ironically, Bank of America turned out to be a bad business model in this
Well,
regulatory
again,
environment,
but
this rate environment, and
Right.
the way that they manage risk.
Right. But I'm just saying, use
that
these
fair, Guy?
opportunities. I'll say it for the 5th time on this call. Use these opportunities and these type of moves to sell stock in companies that are probably not a great business model. And nothing's changed for
That's what I thought I was
2024.
doing with it.
And that's all you
Thanks.
did. But yes.
Yeah.
So.
We're at the crux of where risk
Meets opportunity.
meets opportunity. We're also at 2:30 mark, which is our hard out for today.
Yeah, we got a lot going
I
on.
want to thank the audience. I want to thank Danny Moses, who sat in with us today.
Got right up in there.
Got right
Got
up
right
in
up
there.
in there.
Yeah,
Got
listen,
right up
whatever.
in there.
Danny will be playing golf tomorrow.
You're not?
I will be playing golf as well.
Yeah.
I don't have clubs. I don't have rain gear. Apparently, it's supposed to rain here in South Florida. We'll figure
You don't
that
have
out.
it in that bag you
Storm
brought
done.
that from 1976, that bag? Now I know why you love the 70s so much. That
Should I
suitcase.
tell it? I don't know if anybody's flying back from Naples to Newark on Thursday, but if you are and you see me on the plane, I will be in the same position, staring straight ahead,
Perfect.
just to freak people. And the flight attendants love me because they don't have to do a damn thing.
Not a damn
Not a
thing.
damn thing. It's beautiful.
All right. On that note,
Tomorrow, market call begins.
we don't know yet.
We don't
so
know
stay
yet.
tuned, people. Check
We'll
out
put
our
it out on our
socials.
social because given the
We might have
weather,
to bump it to Friday.
we'll figure something.
We'll figure it out here.
But I want to
people.
thank you for being here. I want to thank CME Group, FactSet, obviously our data provider, Danny Moses,
Demo.
Dan Nathan, Jacob, Amanda, Timmy, Steven, the whole team, kicking ass and taking names. We'll be back tomorrow.
Maybe.
Maybe.
All right. We'll see you. Thanks.